So welcome everyone. Thanks for hopping on with us. We're really excited to have everyone join us for our first live Q&A session with CompStak and Trepp on our newest research report, upcoming Office Loan Maturities, Large Lease Expirations, and Anemic Space Demand, the perfect storm. So let's get into it. Just wanted to quickly introduce the brains behind this report. So we have Ali Bauman of CompStak Research, Real Estate Intelligence Director here with us, and Stephen Bushbaum, Research Director at Trepp here with us.
Awesome. Well, thanks, Bridget. And thank you to Stephen from Trepp for joining us today. Before we launch into the questions, and thank you to everyone who sent them in, there's some really good ones in there. We just want to do a quick overview of why we did this report, some main key points, and then we'll dive right in. So Stephen and I started speaking back in the fall about the first collaborative Trepp and CompStak report. And we were around that time, stories were circling about office obsolescence, what to do about office buildings that are not performing well. And we were also anticipating sort of the 3-year anniversary, if you will, since COVID began and totally upended space demand. So we came on the topic that we want to cover the biggest markets for maturing office loans over the next 2 years, and also dig into the trends of what's been happening there since COVID began in terms of office leasing trends, and what are the biggest tenants expiring, and what is really the headline risks in the sector. And lo and behold, we're not clairvoyant, but over the past 2 months, and since we put out this report, and even slightly before, we've seen a slew of headlines about maturing loans, loans coming up for defaults for office owners in major gateway markets.
Yeah, it was.
So with that, I want to kick it to Stephen, and he'll go over what we saw in some of the major markets in terms of expiring loans. So Stephen.
Thank you, Ali, and thanks for having me. Yeah, the report was well-timed, but I don't think that was our expectation at all, but that's how it works out. So we started out by looking at the markets, the MSAs with the greatest dollar volume of loans maturing over the coming 2 years across both fixed and floating rate loan types. And the reason I mentioned the floating rate specifically are a lot of these loans have extension options. And so while they might be scheduled to mature and they will show up in this report, the big question is whether or not the borrowers in these cases will exercise those extension options. And so some of the headlines we had on this previous slide, 2 of those were loans that had extension options. And one in particular was a really big shock with the borrower really just not wanting to exercise that option. And another one, it was effectively pulling forward that extension option in the form of a default because the deal just wasn't going to pencil out. It didn't make sense to stay in it. And so with those MSAs, the loans maturing within the next 2 years, we wanted to further refine our kind of grasp on what kind of risk we're talking about here when these loans are coming due, and specifically the lease expiration risk. So the columns have highlighted here totals the amount of square footage across the top 5 largest tenants at each of the buildings within these MSAs that is scheduled to expire within the coming 2 years. So on average, if we total up the square footage expiring within the next 2 years for just the top 5 tenants, on average, for this basket of loans, it came out to be about 20% of the total building square footage on average, right? So if you think about that, it basically means 1/5 of your building, if the tenant vacates, or one of these top 5 largest tenant vacates, you could be losing about, looking at a 20% vacancy rate if you're 100% occupied today, right? That's a very big if, and we know that's really not the case on average, right? The natural rate of vacancy in these markets varies from around 5 to 20%, depending on the market. And so thinking about where we've come since COVID and the kind of risk that some of these loans that are coming up and will need to refinance are facing, the second table here highlights what I consider a basket of loans that are facing a pretty significant sticker shock at refinance. And those are the full-term interest-only loans that have a current coupon on the debt of less than or equal to 4.5%. So if you think about, back in, say, 2013, you took out a 4% interest rate loan, or even 4.5% with how much the 10-year treasury is rallied today, you could be looking at a 200 basis point or 2% increase in your interest rate, which means your debt service cost for many of these loans could be increasing by about 40 to 50%, some even as high as 60% on the high side. And so when we think about debt coverage ratio and risk and excess cash flow, historically speaking, we'd think, well, if you have a debt coverage ratio of about 2 times, right, you have twice as much cash flow as you need to cover your debt. Well, if your debt service is going up about 40 to 50%, and we hold that, current cash flow constant, your new debt coverage ratio could be dropping to right about 1.25 times, which if it drops below that, you're going to have a really, really hard time refinancing. That's kind of one of the commonly quoted underwriting metrics or thresholds to qualify for a new loan. And so it's about $6 billion is fixed rate maturing, and about call it half that is that full-term IO low interest rate loan universe. And so I think bottom line, we're going to continue to see a lot of distress creeping up in the office market, which is motivation for us having the Q&A call and embarking on our second piece in the series.
Absolutely. Thanks, Stephen. And so those are obviously some concerning stats. So we looked at many things in this report in terms of leasing and the health of office markets. One of the main things we looked at is what has happened over the past 2 years in terms of transaction size, and especially with lease term, with renewing and extending tenants. We know that during the peak of COVID 2020, that lease term, especially for renewing and extending tenants, dropped precipitously in many markets. And so also the transaction size has also been trending down and hasn't recovered to 2019 levels. So this is concerning because now, as I said, we're 3 years past COVID. And so for anyone who signed a short-term renewal, your lease is coming up this year, next year, or the following year. And so that's also coming at the time when, we know that we're not going back to full pre-pandemic levels of office occupancy. And also it's coming at a concerning economic times with layoffs, rising interest rates. So there's a big concern about, will these trends continue and what will tenants do with these space decisions? And beyond lease rollover risk, which Stephen also covered, we know that effective rents are still flat or below pre-pandemic levels, or in some cases falling faster now. And this really tells the story if you break it out for class of building, as well as by build year and renovation status. So we've seen that there's falling effective rents across the 11 markets we study in buildings built in the 1960s through 1990s, and also for Class B buildings of really any vintage. And these are the buildings that are making headlines for being sort of film, not digital, as RXR stated famously in the media a few weeks ago. And buildings built in the 1960s through 1990s make up the bulk of office inventory in many office markets, especially in markets like New York City. So it's of a great concern what's going to happen there. So we just wanted to give you a quick overview. We'll just throw this slide up. If you have any questions afterwards, please feel free to reach out to us. But with that, I'll give it back to Bridget so we can launch right into the questions.
Awesome. Thank you, Stephen and Allie, for that overview. And we already have a few questions coming in, so really excited to get going on these. The first one, I'll start off with this. So this person asked, the shortening shrinking renewal is a notable stat. Do you have any examples of deals or tenants that reflect these trends? And I think I'll kick this one over to CompStak.
Absolutely. Well, thanks for that question. So there's been a few notable examples of this, and I think we'll start to see more, especially as we have large users have their leases expiring, as Stephen alluded to before. So here's a few examples that I found in New York City over the past few years. Tiffany & Co., the jewelry maker, signed a significant renewal at 205th Avenue, its headquarters in New York, but it reduced its square feet by nearly 200,000 square feet. There were 410,000, and they signed a renewal for 287,000 square feet. So that's pretty significant reduction. We also found another example from BNP, a financial tenant at 787 7th Avenue. They did sign a long-term renewal for 20 years, but they also reduced their footprint from 450,000 square feet to just over 320,000 square feet. And we also found some examples of tenants who reduced their lease term, and meaning that they felt uncertain. Maybe they wanted to reassess at a time that they felt where deal terms might be more favorable, or where they had a clear idea of where the market was going. So in 2020, summer 2020, NBC, major NYC tenant, renewed for less than 5 years. Also, we have a few examples of law firms that renewed for shorter than previous deal terms, and that's also concerning. Law firms, especially in some markets, are long-term traditional office users. So one example is Decker, also in New York City. They had a lease for 15 years, but in 2020 they reduced that to 10 years. So it's definitely a concerning trend when you're having more lease rollover, more sort of tumultuous nature of the market, more tenants rolling over more frequently, and then also reducing space as they continue to reassess their space needs, even if they're working on a hybrid model.
Awesome. Thanks for that, Allie. We also have another question coming in that I think will be a really good one as well. Why is the spread between effective and starting rents concerning? And is the spread increasing just as much for top of the market prime trophy space? I'll kick this over back to Allie, I think, for this one.
Yeah, so that was one of the main points in this report, is that when you just look at the headline rents for a market, asking rents haven't really changed that much, and then base rents for what's happening in the market, meaning the starting rent for transactions, have actually seen some growth. And I think that has a lot to do with there's a larger share of activity, especially in some markets. It's happening in trophy and prime buildings and not in the rest of the market. But even for activity which is happening in trophy and prime buildings, a larger share of what the landlord used to get is going to paying concessions, meaning there's larger free rent periods than there were previously, and also much larger work value packages. So I can give you some examples of stats there. So in New York City, average work values are up by 30% since 2019. In the Bay Area, they're up by 50%. And for free rent, that also increased significantly. And for the top of the market, meaning new construction, prime properties, I think this is a pretty good example. We recently looked at the top 10 most valuable transactions in New York City. And even though those are the highest rents, the most valuable deals, a larger share of those deals went to concessions than they had in previous years when we compiled the same analysis. So for 2019 to 2022, the average work value for those top 10 deals increased more than 61%. And also free rent increased as well.
Perfect. Thanks for that, Allie. This one I'm going to kick over to Stephen. Another question had come in. The report mentions that fixed rate loans maturing over the next 2 years, about 15%, is of greater concern than the floating rate loans. Can you talk a little bit more about why?
Absolutely, and a great question. I'll start off with just saying that when I say greater concern, I'm thinking really in terms of number volume. Because if we think back to two of the really large defaults that just occurred, those were floating rates, very large single asset, single borrower deals. And so the fixed rate ones, why those loans are concerning is we think about how the world looked back in, say, 2013, especially for, say, Class B office in Manhattan. You would have never thought that that asset would really be economically obsolete 10 years down the road. And really, when it gets down to underwriting, one of the issues that some of these fixed rate loans will run into, or conversely, where some of the recent vintage floating rate loans have a little bit of buffer, is that floating rate loans, when they're originated, anticipate some level of interest rate increase, or at least they buffer their risk, so that at origination, the floating rate loans will generally have much higher debt coverage ratios starting out, and so they can absorb some of these increases. Whereas the fixed rate loans are underwritten with really some sort of, I would say, a lower tolerance level. And so the combination of drastic interest rate sticker shock coming up at refinance, combined with, potentially much lower leasing demand, and this overhanging question of, are these buildings still economically viable, I think is going to bring a lot of pain to that segment of the market. And I would liken it to what we saw play out with regional malls. I think that's a very good comparison, most in terms of just, from an analogy standpoint, but also how we'll see the pain roll through the market. And that the regional malls have taken a very, very long time to play out. And back in 2013, we knew that was kind of a heavy risk being underwritten in the market, but we didn't, I think, have as much of an appreciation for just how much of that space would have weak demand or be obsolete in the near term, or say not so distant future.
Perfect. Thanks for that, Stephen. We also had a few more questions come in that were also pre-submitted. We actually got a lot of those, so it's great to see. One of them is, how are the 13 markets selected? Is the exposure more limited in other markets? And I'll pass this back to you, Stephen.
Sure. So the 13 markets were just cut based on, those had the highest total dollar volume of loans coming due within the following 2 years. Outside of what we had in the report, I went back and looked just today at some of the markets that were outside of the scope of our report, but still have significant dollar volumes of loans coming due in the next 2 years. In Philadelphia, San Jose, Seattle, Denver, and Miami all have pretty large dollar volumes coming due. In Philadelphia and San Jose specifically, those have $1.9 and $1.4 billion of loans coming due in the next 2 years. Seattle at 900 million, Denver at just under 900 million, and Miami at 440 million.
Perfect. Thanks, Stephen. Let's go ahead and do this one's interesting. What is the most volatile office market in the country? Either of you want to take a stab at that one?
Well, I think Stephen and I both can. Definitely a challenging question because it's a bit subjective as to what you mean by volatile in terms of leasing demand, the general health of the city's economy, loan risk, expiring loan risk. But I think in this report, we chose to focus on New York City and San Francisco in a little bit greater depth because of the level of loans that's expiring over the next 2 years. And I'd say that we dug in a little bit into what's happening in San Francisco. In the report, we focused on effective rents in San Francisco and how much they're falling in every category by type of building. They haven't seen as much of the flight to quality that has sort of helped the New York City market to a certain extent, where San Francisco is a less diversified office market in terms of industry. And this sort of industry risk is something that Stephen and I want to dig into at our next Trepp and CompStak report. And Stephen, I don't know if you have any thoughts on what you think is the most volatile office market as well.
Sure. And you definitely alluded to what I think we both agree is it's a great question, by the way. I love this question, but how we want to define volatility. And so if we're thinking of, just space demand, San Francisco obviously comes front of mind with respect to the tech wreck. if we think about, the migration trends we've seen since COVID, not just on the residential side, but say even with corporate headquarters, Chicago has had a lot of flight out of the city. Say if we wanted to look at sublease space that's been put to market, Atlanta and Minneapolis are two markets that we've covered in Trepwire, with significant chunks of space that have been listed for sublease since fall of last year, between then and today. Or if we even want to go to the regulatory front, and think of, I guess, called essentially the ESG in general, a regulatory push to modernize office space or try and bring green energy and sustainability to the forefront. Certainly, Houston obviously it could suffer from that, depending on what happens with the oil industry, or even Manhattan with local law 97 and just dealing with energy transition risk. So great question, and so many different ways to answer it.
Awesome, love that. Another interesting one, and I'll probably kick this one over to Allie. Why does San Francisco's rent performance look so much worse than New York City's in this report?
Well, I think that goes to a little bit of what I just said, is that San Francisco hasn't seen as much uptick in terms of lease flight to quality as another market, which it often gets compared to, and it does in this report, New York City. It's heavily dependent on the tech sector. The tech sector across the board in the United States was sort of the industry that's been working from home the most earlier in the pandemic. It also, at the same time it was working from home the most, it did sort of buoy the leasing market, and that we saw big tenants still taking space, even as they were telling their employees, you can keep working from home, for now. But, going towards the end of last year and definitely this year, we see a big difference in what's happening, and that they're sort of changing their stance. We've seen companies like Google saying that they're going to start looking at creating greater efficiency in their space. And then Twitter just made the headlines, actually, with putting space up for sublease in New York City, but I think they're also looking at it in San Francisco as well. So I think those are some of the challenges there. And I think Class B space, if you look in the report in San Francisco, shows a much steeper decline than it does in New York City. And I think that's worth digging into, because Class B space over the past 10, 15 years, especially in San Francisco, some of the space that was sort of the growth space for the tech startup sector. And it was very popular. And so that market has sort of fallen off, and that, and that's some of the kind of space where in San Francisco and across markets, across the country, where we're thinking about how can we repurpose that. And it's a big part of the office to residential conversion story. So thanks for that question, Bridget.
Thanks, Allie. Stephen, we had one come into the Q&A chat that I think I'll shoot over to you. So have you seen any loan structure change? Are we seeing more prepayment options for the high fixed floating rate loans executed recently, and anticipation of a lower financing costs in 2 to 3 years?
Fantastic question. And thanks to the audience for that one. So we haven't had a lot of new issue. So that'll absolutely be something that I am looking forward to digging into when we see the pipeline pick up, because I think, what that question is alluding to is spot on. Effectively, if borrowers are wanting some sort of optionality baked into the loan structure to make it less costly to refinance. And I do expect that'll be the case to some extent. One particular contract or structure change that I found recently, and I can't reveal the exact deal because of 144A privacy issues, but it was a very interesting and I think very important structural change to highlight here. Floating rate loans, the recent vintage ones, I mentioned the borrower, the lender anticipate, right, there'll be some level of potential increase in the future in interest rates. And so debt coverage requiring, fairly high starting debt coverage ratio is one way to buffer against that. One of the other contractual things that is really designed to tackle this issue specifically is that the borrower has to buy a rate cap in a lot of cases for these loans at origination, which just means that, say if 1.25 is the golden debt coverage ratio, that the lender doesn't want to see cash flow fall below that level and put the loan at risk of defaulting should interest rates increase. The lender will just back into what interest rate that is that would cause the debt coverage to drop to that level. And then the borrower at origination will buy the strike price is that, interest rate, that higher interest rate, right? So they're basically buying a hedge against increases in interest rates. Well, now that we've gotten into a higher interest rate environment and we've seen as much volatility as we have in treasury markets, you'll hear that referred to in option pricing sometimes as the sigma, and that plays into the cost of purchasing that hedge. Well, the hedging cost for these floating rate loans, the purchase of the interest rate cap, is substantially more expensive. When I say, substantially, it might have gone from, say, $100,000 to buy an interest rate cap at origination for a sizable SASB loan to now, $10+ million potentially. I was just pricing one earlier this week. And so if you think back to good old loan structuring, another way to buffer against interest rate increases is just to have a reserve set aside at origination, rather than having to buy, potentially what could end up being a more costly interest rate cap. And so this was a long-winded answer, but getting back to what I saw in this contract was, instead of just saying that, basically there's no other option than buying an interest rate cap, this contract allowed the borrower to buy effectively a lower interest rate cap that would be less expensive, and then set aside reserves against the difference that would have been required under the interest rate cap that would have been required if no other options were on the table. So that effectively lowered the cost at origination for that loan to hedge against future interest rate risk. And so I think that'll be a very interesting piece to see going forward if this recent environment gave us some lessons in, what should be tweaked going forward in structuring floating rate loans.
Awesome. Thanks for that, Stephen. The next one, I'm going to let both of you answer this as well. Has there been any uptick in leasing in Q4 2022 or Q1 2023 in any sectors? What are the key markets to keep an eye out for?
I can start. So I think that's a bit of a challenging one to answer. I think Q4 and Q1 have been kind of a disappointing start to what's ahead in terms of leasing. I will say that we've seen some of the FIRE sector picking up some of the slack from tech and TAMI tenants. And here's a few examples of what we've seen there. Probably the best one that sort of shows that is KKR. Took 220,000 square feet that was left behind by Facebook, Meta, if you will, at Hudson Yards in Manhattan. And that was a late Q4 deal. And so the FIRE sector seems to have taken more of the larger deals, most valuable deals. And so that's kind of the sector that everyone's looking to, that's maybe has a little bit of attention ahead, but the tech sector is definitely of a great concern. Stephen, do you have any thoughts on sectors to look at?
Just some similar comments to follow up on that. We've seen some, what I would say is positive upside surprises in Manhattan for FIRE sector leases. So those were effectively, bringing occupancy up pretty significantly for these buildings, and were some big wins. What I think will also be interesting to see, at least for San Francisco, is what's the bottom? How low can it get before all of a sudden you see some tenants think, well, if San Francisco does have a future in the office sector, and we're thinking about, growth going forward, at some point, if you're a growth company and looking to expand, this could be a really attractive point in the market to sign a lease and basically, extract as much of the concessions as you can at the bottom, if that's where you think we're at.
Awesome. And I like this one that was submitted to us. When underwriting an office building, 5% is the standard vacancy loss included. Should there be a new model or assumption going forward, since we're obviously well above 5% and have been for a while now? And I think I'll pass that to you, Stephen.
Sure. That's a great question. And I think thinking back to the CREFC comments from last summer in New York, and certainly what I've heard since then, this is spot on, right? If you're, say, underwriting a 10-year term loan or a deal, what you're underwriting for, see the exit cap rate or cash flow and vacancy in your assumptions from years 5 to 10 is really, really uncertain right now. And I should also note that the vacancy rate varies widely by market. So we used to have a joke with certainly Dallas and Atlanta office, because you have fairly low frictions to add space in those markets. You would just typically have this perpetual 15 to 20% vacancy rate. And to think that we could be, underwriting that rate even higher is kind of scary. It's like 70% occupied, the new stabilized. So I think that's critically important. But one other line item I think worth noting here is the flight to quality, right? The amenities that are demanded by today's tenants are substantial. And so what is being penciled in for tenant improvements, especially, right? If you're having to put cash into a deal to bring it up to par with what tenants want, flex space, high-end build out, what have you, that's a real significant hurdle, and could be the difference between positive or negative cash flow if you get it right or wrong.
Yeah, I think that's a great point, Stephen. And today we're going to put out a blog about work values that tenants receive. But remember, that's just what tenants are receiving to build out their office space. There's other capital improvements that landlords are thinking of to put into their building, which also costs money, putting in amenity spaces, new rooftops, restaurants, gyms, and that all is a significant amount of capital. And guess what? That's also happening at a time when, while construction prices have come down, everything is a lot more expensive than it was 3 years ago. And as we know, rents haven't gone up by the same amount.
Just to put you on the spot, Ali, I'm curious, because like when we talk about the amenities here, it's like, are we talking about an office building or a clubhouse? What kind of dollar amounts and TIs is it taking? The range, at least, to you're seeing some of these leases put in, because I've seen some staggering numbers.
Yeah, I'd say, as I spoke about earlier, we covered how work values have trended, especially for the most expensive leases in the market. So these are leases like in One Madison, other buildings like that, and it's triple digit is, really the norm. $130, $150. And, that's a one-time expense, but that's a lot of money that the landlord is putting out to attract, these tenants to their building.
Yeah, I mean, I don't have the numbers in front of me, but I have to guess that's probably double, what we would have seen, about 10 years ago, easily.
Absolutely. It's up by a substantial amount, even 20, 30, 50% since 2019. So pretty significant.
Yeah.
Great. Thanks, Ali and Stephen. That was a great one. This one I want to kick to Ali that we had submitted. How does pressure on office leasing stratify by size of space? Are large spaces under more pressure?
Well, I'd say that we covered how average size of transactions for new deals, meaning tenants who are expanding to a different space or they're relocating, that's coming up back to the pre-pandemic average for tenants who are closing deals, who are in the market. But for renewing and extending tenants, it's tending to trend down. So it's definitely something that is a concern. Traditionally, we have depended on big transactions to drive absorption, especially with some of the record levels of new construction that we've seen over the past few years. And large users are also reevaluating their space needs. But it's interesting if you look at the data that it looks like rents are going up for users who are above 100,000 square feet, because those are tending to be the tenants that have the capital, like fire tenants who feel confident in the market and are signing deals. We've seen a decline in lease terms for smaller tenants in the market, so sub 30, 20,000 square feet. So that suggests that there may be more unease in smaller tenants in the market. They're more cost conscious, and they're less likely to make long-term commitments.
Thanks, Sally. And we just had one come through the Q&A chat, and I think this will be great for Stephen over at Trepp. So this one is, on office defaults, this is becoming more common, but will workouts and extensions be the norm also because banks increasingly do not want these assets? There's been others, but for instance, GFP defaulted on 515 Madison Ave a few weeks ago and made the news about it, but then a few days later, it was announced an extension was reached.
Yeah, this is a fantastic question. I love it. It's near and dear to my heart because I've done some academic research on this front. And I think we're going to see a lot of kind of strategic positioning by borrowers. And, at the end of the day, okay, let's just ignore the game theory and, the back and forth of all it and think about this from the borrower's perspective. Obviously, they don't want to plow money into and stick around with a property at the end of the day they think doesn't have a future. And so the middle ground will be, say the class A minus, B plus, even great location, class B building that the borrower's thinking, well, it doesn't look great right now, but times are also really uncertain. So if I walk away and things recover, I could be leaving money on the table. But conversely, I don't want this to be a really expensive, endeavor to keep that optionality. And so for those, that middle ground right there, the gray area, I fully expect to see some of this gaming come to the forefront to try and, basically lower the carry cost for the asset. And we're going to probably start hearing this term that was, I would say at some point overused coming out of 2008, but the lender and borrower will be effectively kicking the can down the road with some of these modifications, because like I said, right now it's highly uncertain. But if we're looking at, say, Europe and Asia, there's a good Wall Street Journal article earlier this week talking about how they were, leading the US in utilization rates and back to office. Well, if we think that the US might be going that, maybe not full back to office pre-pandemic utilization rates, but certainly better than it is right now, that you'll want to try and stay in the investment if it's not too costly. So great question.
Awesome. Thanks, Stephen. I think we have time for about one more question. And I like this one, so I'm going to go with this one as well. So in the report, the markets with the highest average of top 5 tenants expiring in 2 years are Houston and Dallas-Fort Worth. Why might this be the case, even as we see news of more corporate relocations to Texas? And Stephen, I think you can take this one.
Sure. And it's a great question. So I'll start off with answering this from the statistical and urban economics side of things. So on a relative basis, right, the percentage of building, if we're looking at the larger markets, like say Manhattan, the density is a lot higher in those markets. So in other words, the buildings are going to be taller, total square footage is going to be more substantial. So if we think about, say your average medium to large sized company, the amount of square footage they're going to acquire, it's simply just going to be a lower percentage of building area the larger markets, or conversely higher in the lower density markets, like say Dallas and Houston. So some of that is just a phenomenon of urban density. But also some of it too is, I think like with the shrinking renewal, some of that could be also optionality, but part of it is truly a little bit of a statistical urban economic phenomenon.
Perfect. Thank you for that, Stephen. I think this ends really well right up to our 45-minute line. So I just want to thank everyone for hopping on with us today to go through a lot of the questions that everyone had. We actually got through all of the live questions, which is great. If you have any other questions, don't hesitate to reach out to us. I'm going to put our email in the chat. It's marketintel@compstak.com. If you would like to sign up for our newsletter as well, feel free to shoot us an email. Every week we come out with our own analysis of trends in CRE, and we'd love to have you join us on that list. Thank you, Ali and Stephen, for your time here. And thank you everyone for joining us.
Thanks, Bridget. Thanks, Ali.
Thanks, everyone. Thanks, Stephen, Bridget. Bye.
Bye, everyone.